Hey guys, welcome back to the channel. It's me, Adam. You're watching Steady Invest, and in this video, I'm going to be talking about Mark Cuban. For those that don't know, he is a multi-billionaire. He has been featured on Shark Tank. He's been on CNBC plenty of times talking about cryptocurrencies. He is the owner of the Dallas Mavericks, which are an NBA team.
I think buy and hold's a crock of. I think the idea that you always have to invest your cash is not far behind.
So you make one-way bets. This isn't portfolio balancing you're talking about.
All that asset management, diversification, that's for idiots, right? Because you can't diversify enough to know what you're doing.
And so I was watching a YouTube video last night, and they were talking briefly about Mark Cuban and how something about options and the dot-com crash, and I had no idea what they were talking about, so I Googled it, found this article, super interesting, want to share it with you guys. So yeah, the genius options trade that saved Mark Cuban billions of dollars. If you've ever watched Shark Tank, you've probably heard the intro to the show introduce the billionaire investor, including Mark Cuban. But not many know how Cuban made those billions or how he employed a genius option strategy to prevent his billions from turning into nothing during the dot-com crash at the end of the 90s. In this post, I'll break down Mark Cuban's strategy, and I'll also post a ton of Mark Cuban gifts, so get ready. How Cuban made his billions. In 1995, Mark Cuban and his business partner created Broadcast.com. This website streamed audio and video for radio, TV, and sports. Nowadays, that's nothing impressive, but in 1995, when most people weren't even using the internet, it was revolutionary. And when you sell your company for $5 billion in 2 years before it becomes obsolete, and you see Mark Cuban gif over here. At the same time, Yahoo had a market cap of $130 billion. In the run-up to the dot-com crash, they reached a peak valuation of $300 billion before crashing all the way down to $10 billion. And if you're in the stock market right now and you've been facing some volatility, imagine going from a valuation from a peak of $300 billion to a trough of $10 billion. So Yahoo bought Mark Cuban's company, Broadcast.com, from Cuban for $5.7 billion. As part of the deal, Mark Cuban received 14.6 million shares of Yahoo stock, which were worth about $95 at the time. This meant, on paper, his worth was about $1.4 billion. One of the restrictions on the sale was that Cuban wasn't allowed to sell his stock for another 3 years, and you see this a lot with IPOs and SPACs, so there's lockup periods and warrant periods and whatnot. So having all of your net worth wrapped on one single company is a recipe for disaster. Just ask anyone who worked at Enron or is in the stock market right now, or even Yahoo during the dot-com crash. Your entire net worth would evaporate and leave you broke. So if you can't sell the stock, what can you do? Cuban was smart, and he hired some smarter guys from Wall Street to come up with a way for him to protect his wealth via stock options. So the costless collar, and this is an option strategy that I had no idea about until I read this article here. So the strategy Cuban used is known as the costless collar. A collar is used when you own stock and want to protect yourself from any downside risk. The way you do this is to buy a put option. If you have 100 shares of stock worth $95, you can buy a put with a $90 strike price, which means if the stock drops below $90, you can sell the person who sold you the put all of your stock at $90 per share. A bit of a mouthful. Try to read that again. So even the stock goes to $0, the person is still obligated to buy your stock for $90. This is how you limit your downside. So a lot of people, what they do is when you own stock that you're long on, let's say use Tesla as an example, but you're afraid of the short-term risks, people will buy short-term put options on Tesla in case it goes down, even though they're long on the position long-term. So here's a picture showing visually what a costless collar would look like. The x-axis shows the price of the stock, and the line on the graph is your profit. As the stock price moves down, your profit never crosses $0, guaranteeing no losses. As the stock price moves up, you can actually make money up to the strike that you sell your calls at. So that's the entire strategy, but the problem with this trade is that it costs money. Depending on the volatility of the stock, these options could cost anywhere from 5 cents to $5. I don't have any exact pricing from 1995, but in Cuban's scenario with 14.6 million shares of stock, to protect all downside risk, he needed to purchase 146,000 option contracts. Since one option contract controls 100 shares of stock, just divide 14,600,000 by 100, and you can figure out how many contracts are needed to offset your stock position. So purchasing 146,000 puts would not be so cheap, especially on such a volatile stock like Yahoo. The higher the volatility, the more expensive it is to buy options. Also, since Cuban's contracts were 3 years out in time, the premiums on these would be really expensive. If you own Yahoo at $95, the odds of it going to $90 in one day are pretty low, so the put option expiring 1 day out would be a very inexpensive. But the odds of Yahoo going below $90 3 years from now are much higher, probably 50-50 assuming random movement. And this is what I'm kind of doing with my leaps right now, is I'm buying long-term call options, and so they're more expensive the longer out they are, because there's a higher chance they get into the money or they reach the strike price. So to avoid losing part of his $1.4 billion to buying put options, Cuban also sold call options that would offset the price paid for the puts. Absolutely genius. Selling a call option on stock you own is a common strategy known as a cover call. And this is what I'm doing now, but I'm not really buying puts. I'm selling puts, selling calls. I made another video about that called The Wheel, and other different option strategies, but not the costless caller. This strategy limits your upside by guaranteeing that if the stock passes a certain price, you'll be obligated to sell your stock to the person who purchased the option you sold. So to summarize Mark Cuban's trade, I think this number is wrong. So Mark Cuban owned 14.6 million shares of Yahoo at a value of $95 per share. He bought 146,000 put options with an 85 strike, and he sold 146,000 call options with a 205 strike. The premium paid for the put option was equal to the premium he received for the call options, which means he paid $0, except for the commissions. So at the time of the trade, Cuban's net worth was $1.4 billion. If Yahoo tanked, Cuban was guaranteed he could sell all of his stock at $85 per share and receive $1.2 billion. If Yahoo took off and went past 205, he would be forced to sell at that price for a total of $3 billion. But he gave himself so much room, it was a win-win situation. And if we take a look at the conclusion over here, options, not just speculative gambling. A lot of people are quick to dismiss options as a risky derivative or legalized forms of gambling on stocks that can't be further from the truth. With the right strategy and game plan, options can be a critical part of your portfolio, and in some situations, like the one Mark Cuban found himself in, they can literally save you from losing billions of dollars. Of course, the hardest part is getting the billion first. Protecting it is much easier. And I couldn't agree with this anymore, honestly. When I first started looking into options, I thought it was pretty speculative as well. I was pretty suspicious. But the more I looked into it, I realized that you could really, do some damage to the stock market if you gain the experience and you implement a strategy properly. But nothing comes easy. It does take a lot of time. And speaking from first-hand experience, I can tell you that option trading is not easy, but it is one, if you can get good at it, it's extremely powerful, extremely lucrative, and it's just something that takes experience, like anything, any skill that you want to learn. Otherwise, guys, I hope you enjoyed this video and learned something about Mark Cuban and options and how they can be very powerful and how they can be a critical part of your portfolio. And if you haven't already, please like the video, subscribe to the channel, and I'll see you guys in the next video.